Hello and welcome once again to my YouTube channel, Engineering Progress, and today we will be talking about the secured virtual currency popularly known as cryptocurrency. What are cryptocurrencies? We will be breaking down all the terminologies and operations, bringing them into digestible bits. This is a guide for those who have no experience in the crypto market and also for those who want to further their understanding of the inner workings of the market. While you are here, do not forget to smash the like button and subscribe, as this helps the channel to grow. Remember to turn on notifications to get the latest videos as they drop. After all this much talk, let us get this module started. Cryptocurrencies. What on earth are those? Those who took the leap of faith during the infancy and gradual growth period of the cryptocurrency market had to do that like Columbus traveling through uncharted waters and the discovery of the Americans. But that faith was paid, as in the last 5 years the returns on investment in most cryptos had been in leaps and bounds. Although 2018 was a wild one for cryptocurrencies, which had a lot of ups and downs experienced majorly in Bitcoin, this has however steadily improved itself as the growth of major vendors such as Bitcoin and Etherum against the dollar has been great. But for those who are new to cryptocurrency and the act of trading cryptos, however, the sheer volume of investment options and new technology can feel overwhelming. By taking steps to better understand what we are getting into, you will understand and make better investment decisions. To that end, we are going to take a detour and enlighten you on what cryptocurrencies are. Without much ado, what are cryptocurrencies? Bitcoin, blockchain, initial coin offering, Ether, exchanges, and other jargon associated with the cryptocurrency sector have raised solid attention and uproar in the media, online forums, social media, and even dinnertime TV and radio conversations. Despite all the attention, most people do not truly comprehend the meanings of these terms. The initial impression most people had about cryptocurrencies was the stigma that it was the haven for criminals and money launderers. Cryptocurrencies have come a long way in the aspects of both technological advancement and popularity. To this end, we need to delve into the meaning and application of cryptocurrencies. Cryptocurrencies are digital assets that use cryptography, which is an encryption technique, for their security that makes it nearly impossible to counterfeit or double spend. Many cryptocurrencies are decentralized networks based on blockchain technology, a distributed ledger enforced by a diverse network of computers, this being a defining feature of cryptocurrencies, as they are not issued centrally by an authority, therefore rendering them theoretically immune to the influence, interference, and manipulations of world's governments. Therefore, in essence, cryptocurrencies are digital currencies, if you will, which are used in the buying and selling of goods and services both traditionally and on the internet securely. For the sake of being historical, which is important, the first blockchain-based cryptocurrency was Bitcoin, which as today is still the most popular and most valuable virtual asset to have. As of right now, there are thousands of alternative cryptocurrencies which perform various functions and have diverse specifications, some being clones or forks off Bitcoin, while others have been built from the scratch up. Some of the high-ranked cryptos presently include Bitcoin, Solana, Litecoin, Ethereum, Cardano, and EOS. It is worth knowing that by November of the year 2021, the aggregate value of all the cryptocurrencies in existence was over $2.4 trillion, as Bitcoin currently holds the largest total value of 42%. Now that we have an understanding of what cryptocurrencies are, we need to know what is crypto trading and how is it done. Like forex trading, cryptocurrency trading is the act of speculating on cryptocurrency price movement through CFD trading accounts, or by buying and selling the underlying coins through an exchange. CFDs trading are derivatives, which enable you to speculate on cryptocurrency price movements without taking ownership of the underlying coins. By implication, you can decide to go long buy into a cryptocurrency if you think the cryptocurrency will rise on value, or go short sell a cryptocurrency if you think it has the potential or is falling. These are leveraged products, which means that you only need to make with a small deposit known as margin to gain full exposure to the underlying market. The profit or loss you will earn is calculated according to the full size of your exposure in the market, so leverage will magnify both profits and losses. Buying and selling cryptocurrencies through an exchange. When you purchase cryptocurrency through an exchange, you buy the coins themselves, and you will need to create an exchange account, put up the full value of the assets to open a position and store the cryptocurrency tokens in your own wallet until you are ready to sell. A word to the wise, exchanges are known to and will bring their own steep learning curves, as you will need to get an understanding of the technology involved and learn how to make sense of the data. Also, a lot of exchanges have set limits on deposit amounts, while maintaining accounts can be very expensive. So how do cryptocurrency markets work? These are decentralized, meaning they are not issued nor backed by a central authority such as a government, which eludes cryptocurrencies of the influence and politicking of governments and her agencies. Instead, they run on a network of computers. However, cryptocurrencies can be bought and sold through exchanges and also stored in wallets. Distinct from old-style currencies, cryptocurrencies exist only on shared digital records of ownership, stored on a blockchain. When a user wants to send cryptocurrency units to another user, they send them to that user's digital wallet. This transaction is not considered final, however, until the transaction has been verified and added to a blockchain through the process known as mining. This is also how new cryptocurrency tokens are usually created. What is cryptocurrency mining? Cryptocurrency mining is the process by which recent cryptocurrency transactions are checked and new blocks are added to the blockchain. What is blockchain? A blockchain is a shared digital register of recorded data for cryptocurrencies. This is the transaction history for every unit of the cryptocurrency, which shows how ownership has changed over time. Blockchain works by recording transactions in blocks, with new blocks added at the front of the chain. Blockchain technology has unique security features that normal computer files do not have. Mining computers compile valid transactions into a new block and attempt to generate the cryptographic link to the previous block by finding a solution to a complex algorithm. When a computer succeeds in generating the link, it adds the block to its version of the blockchain file and broadcasts the update across the network. Leverage in cryptocurrency trading. Leverage is the means of gaining exposure to large amounts of cryptocurrency without having to pay the full value of your trade up front. Instead, you put down a small deposit, known as margin. When you close a leveraged position, your profit or loss is based on the full size of the trade. While leverage will magnify your profits, it also brings the risk of amplifying losses, including losses that can exceed your margin on an individual trade. Leverage trading, therefore, makes it extremely important to learn how to manage your risk exposure. What is margin in cryptocurrency? Margin is a key part of leverage trading. It is the term used to describe the initial deposit you put up to open and maintain a leveraged position. When you are trading on a margin in cryptocurrencies, remember that your margin requirement will change depending on your broker and how large your trade size is. Margin is usually expressed as a percentage of the full position. A trade on Bitcoin, BTC, for instance, might require 15% of the total value of the position to be paid for it to be opened. So instead of depositing, say, $5,000, you would only be required to deposit $750. What is a pip in cryptocurrency trading? Pips are the units used in measuring the movement in the price of a cryptocurrency and refer to a one-digit movement in price at a specific level. Generally, valuable cryptocurrencies are traded at the dollar level, so a move from a price of $190 to $191, for example, would mean that the cryptocurrency has moved a single pip. However, some lower-level cryptocurrencies are traded at different scales, where a pip can be a cent or even a fraction of a cent. It is important to read and understand the details on your chosen trading platform to ensure you understand the level at which price movements will be measured before you place a trade. Now, we need to understand which factors influence the pricing of cryptocurrencies. What causes cryptocurrency prices to rise and fall? Though supply and demand certainly play a role, crypto investors should carefully consider the perceived utility of a currency. If a coin is perceived as having several practical applications, it will be highly sought after and therefore gain a price increase. However, as they are decentralized, they tend to remain free from many of the economic and political concerns that affect traditional currencies. As MyCryptopedia explains, mining difficulty is another major factor that affects pricing. A higher mining difficulty means that it is harder to mine an additional unit of a coin. This can have an impact on a coin's perceived value, and subsequently, its price. as increasing a coin's supply will require more computing power to be used in the mining process. News headlines regarding different coins and tokens are a solid source of information that influences decision-making and should be paid a lot of attention by savvy investors. Positive or negative articles will often have a direct correlation with future pricing trends. Amongst these, other factors that affect the crypto marketplace, which includes supply, which is a basic economic phenomenon that affects the crypto marketplace. It entails the number of coins and the rate at which they are released, destroyed, or lost. Market capitalization, the value of all the coins in existence, and how users perceive this to be developing. Press, the way the cryptocurrency is portrayed in the media, and how much coverage it is getting. Integration, the extent to which the cryptocurrency easily integrates into existing infrastructure such as e-commerce payment systems. Key events, major events such as regulatory updates, security breaches, and economic setbacks. The spread is the difference between the buy and sell prices quoted for a cryptocurrency. Like many financial markets, when you open a position on a cryptocurrency market, you will be presented with two prices. If you want to open a long position, you trade at the buy price, which is slightly above the market price. If you want to open a short position, you trade at the selling price slightly below the market price. Now, with all these, it begs the question: how does cryptocurrency make money? Cryptocurrencies provide secured payments solutions online that are denominated in terms of virtual tokens. They are represented by ledger entries internal to the system. Investors make their money with cryptocurrency by either mining Bitcoin or any other crypto, or simply selling their cryptocurrency at a profit. What are the signs which tell you to sell your cryptos? Knowing when to sell is an important skill to have when trading and investing in cryptos. Picking the right moment to ditch an asset determines if you are going to make a profit or a loss. But just how do you recognize that perfect moment? Well, we have drawn up 8 indicators telling you when to act. 1. When you've reached your goal. This looks like a piece of basic advice, yet, you'd be surprised how many people ignore this. When you have invested in an asset, it's paramount to set a profit goal. For example, you may wish to multiply your investment by 2 times. If you buy an asset when it was priced at $10 per coin, it would mean your moment to sell is when the price climbs to $20. During this price surge, you may be tempted to wait and see just how high the value can climb, but be advised not to. Ideally, your profit goal should be based on market research and analysis, thus anything above the target price is high-risk territory. It is important to exit when you are happy with the profits and not to look back. 2. You've hit your loss limit. Every trader or investor has their level of risk tolerance. For example, you have invested $10,000 to buy 10,000 coins and do not want to lose more than 20% of your initial investment, therefore it becomes imperative to sell if the price of one token goes down to 80 cents. Here lies the problem, as it becomes increasingly difficult to seize the right moment manually because cryptocurrency prices fluctuate incessantly. The recommendation: use stop-loss orders. This is a useful trading tool your exchange provides. 3. The price has been going down steadily. There has been a steady downward slope of the value of your investment over the last few months. Unfortunately, you might be holding on to a dead coin. Do not let this bother you, as you are not alone in this ship. At the writing of this article, over 1,000 cryptos have failed for one reason or the other. The best option is to sell your crypto without any delay to avoid further losses. 4. The price has skyrocketed. This being the opposite scenario, your coin has shown a sudden upsurge. You take a look at the trading chart and notice the price making new highs. What if the price will continue to improve in value down the months, so it would be better to wait? It is possible. Theoretically, everything is possible. But the cryptocurrency market is highly sensitive and volatile. A sudden price rise can be due to something a famous expert said recently, or an anticipated event like halving, or it may be just a splash one of the crypto whales caused. Whatever the reason, the price swings are likely to go down, and soon. Do not fail in selling your crypto or part of it at the right moment and make a good profit. 5. Your trading strategy dictates to sell. The trading strategy is a pre-made framework that guides your trades. Among other things, your strategy will tell you when to sell your asset. An example: if you are position trading, you may hold on to your crypto for several months. If you are a swing trader, you buy and sell more often, making a profit on smaller ups and downs. Our recommendations: you develop a strategy beforehand and stick to it. It will act as a guide through small losses and stop panic selling as long as your strategy is solid. 6. There are negative rumors around the project. Crypto is hugely vulnerable to what people say. On this market, you often buy the rumor and sell the news. It applies even to the best performing assets like Bitcoin, BTC, let alone young coins. If you notice the following rumors in circulation on the internet, ditch that asset. Technology issues. Major investors going back on the deal. Internal conflict within the team. Legal battles. Major security breaches and hacks. These trigger a price drop of assets involved and cause many investors to lose faith in the project. They will start selling their tokens massively. 7. You expect legal complications. Currently, many governments do not know what to do with cryptocurrencies. Some tend to be friendly and permissive, such as Germany, the UK, Estonia, Malta, Japan, while others are cautious or utterly hostile, such as China, Nigeria, Vietnam, India, and Russia, just to mention a few. When news starts flying of upcoming bans or massive screw tightening, have it at the back of your mind that most mainstream investors do not want to mess with something illegal or semi-legal. Consider selling early before the news hits all the media and drives the price downwards. 8. A better project has entered the market. New crypto projects appear regularly, and many of them are labeled as revolutionary. For instance, Ethereum was challenging Bitcoin when it emerged in 2015. Now, NEO and Cardano all have the promise to kill Ethereum. Most of these threats are marketing tricks and wishful thinking, but others may be real, as there will always be the chance that a new project will outshine the one you have invested in. The golden rule: make adequate research and assess all the risks involved. If industry experts agree that this new project is far better than the one you are currently invested in, consider selling and reinvesting your funds. Again, when it becomes common knowledge, the price will nosedive. Take everything at face value. Note that these are general recommendations, not investment advice. The bulk of the responsibility rests on your shoulders, and you decide on either holding on to your coin if you have faith that it will recover and grow, or letting go, but you need to be aware of all the risks attributed in all scenarios. And with this, we have come to the end of this video. We have taken our time and yours in breaking down to digestible bits those complex, sometimes technical gibberish that tends to confuse most people on the outside, and are ignored by many on the inside. We have also given some trade secrets in the market, like when it is important to sell, what to do when rumors start arising on an asset you are trading on, and how to position yourself to avoid losses. We would love to hear from you guys, so drop a comment in the comment section if you feel we missed out on some things, or you have an opinion on how to make the channel better. See you guys next time.